The International Monetary Fund's global economic outlook is somewhat more upbeat than many of those we've seen since the crisis began in 2008. The IMF forecasts global growth at 3.6% in 2014, up from 2.9% this year. The best news is for high-income countries, whose growth rate should nearly double from 1.2% this year to 2% in 2014, and for the UK in particular, whose forecast was revised upwards by more than any other country. Yet, the overall tone remains extremely cautious. Global forecasts were slashed as a result of slower than expected expansion in the developing world. The IMF is also warning of the big policy challenges facing both developed and developing economies. Its economists believe that most governments had ducked the structural reforms needed to put the global economy on a sustained growth path. For years, we've been used to the fund singling out emerging markets as the best students in the global class. A few months ago, Christine Lagarde, IMF chief, was talking about a three-speed world, with developing countries leading the pack, the US somewhere in the middle, and the Eurozone lagging behind. Not anymore. The IMF has downgraded EM's forecast as it expects them to be hit by a double whammy of low commodity prices due to China's rebalancing and fast capital outflows due to the US Federal Reserve imminent tapering of its asset purchases. The fund is a little more optimistic about the Eurozone, which is now expected to grow by 1% in 2014, up from negative 0.4% this year. The IMF is encouraged by some early signs of internal rebalancing, with unit labour costs falling in countries such as Spain. Yet the fund believes that the situation remains fragile, pointing at the sky-high unemployment rate in the periphery. As a result, in the report there is a long shopping list of recommendations for European governments. Surplus countries such as Germany should boost domestic demand to give space to the struggling deficit countries. The other key recommendation is to shore up Europe's still fragile financial sector. The fiscal drama in Washington is the single largest unknown in today's report. The IMF forecasts are based on the assumption that politicians will eventually find an agreement on the debt ceiling. Were sense to return, then growth in the US should hit 2.6% in 2013, up from 1.6% this year. The fund believes this is good enough for the Fed to exit quantitative easing and ultra-low interest rates. Yet, this will not be a smooth process. While the consequences of tapering will be far milder than those of a US default, the world economy should still expect a bumpy road ahead. Ferdinando Giugliano, Financial Times, London.